We've got a busy week ahead for financial markets, big focus on the central banks, but it's worthwhile taking a minute to note the potential impact this US CPI report could bring upon markets as people become increasingly fearful around the potential for a resurgence in inflation. So let's dig deep into some of the key charts to be looking out for and understanding how this US CPI report could influence the likes of US equity markets and also the dollar. So as ever, we'll look first and foremost to see exactly what markets are expecting for this report. And you can see it here, according to Trading Economics, the core inflation expected to come in once again at 0.3%, keeping the year-on-year figure at 3.3. And then in terms of the monthly number, 0.3 up from 0.2. And that's helping the annual figure move up to 2.7. Of course, this is key to the concern, right, is the idea that we're going to see inflation moving in the wrong direction, and pairing that off against some of these other regions where they feel emboldened about the idea that they can continue to cut interest rates as people really rein in those expectations around the Federal Reserve. Now, this is the outlook for headline inflation. And what we can see here is 2.58 is the current level of inflation. Now, crucially, the part we really want to focus on is the middle section. And that's because essentially the year-on-year figure is made up of 12 month-on-month figures, right? And so if you don't look at this monthly breakdown, then you won't necessarily gain a particularly strong grasp of the actual direction of travel for inflation, right? So you could have huge amount of inflation that had taken place 11 months ago, 10 months ago, 9 months ago, right? So it's in the past, we've moved away from that period. And instead, the numbers that we've been seeing recently on a monthly basis may be very low. And in which case, this would make the likes of the central bank and likes of the markets really feel confident that, okay, fast forward 5 months, let's say, all of those big numbers in the past drop out. Suddenly you see a massive amount of disinflation. And that's where that year-on-year figure is really impacted. Well, what's the case here? Now, we saw that 2.44 reading last time around on a monthly basis, and that is a bit higher than we would like it to be. It's above where we'd need that around 0.16 figure if we're going to hit 2% for the annual headline CPI figure. However, it comes off the back of 5 months worth of readings that are either at target or just below target. And so this is a good example of where in the past we saw some pretty hefty prints, in particular in Q1 of this year. But when they're stripped out, there's a good chance we're going to see headline inflation around where we need it to be. And so last month's reading of 0.22 isn't necessarily a problem. If we look at what markets are expecting, they're expecting a 0.3 figure, so a higher number yet. But bear in mind, 0.3 could be 0.255, right? It was round up or round down. So this one got rounded down. And so we're sort of around about 0.2.5 anyway. So I would say that by and large, your headline inflation isn't a problem at the moment. You can see that the 3-month annualized figure does sort of, it's been ticking up following that period where we saw those real lowly figures in May and June. But it's, it's there or thereabouts. It's not necessarily the kind of thing that's going to hold back the Federal Reserve. And part of that is because of the role played by energy. And certainly because of what we've been seeing over the weekend in terms of Syria, people are starting to wonder about, what's going to happen in terms of energy markets whenever you see potential shifts in power, upheaval in the region. You do often have some sort of question marks about what the implications might be for energy markets. We haven't necessarily seen much of that, but what's notable here is when you chart the likes of WTI against the monthly change in terms of US CPI, you can see that generally when we see major swings towards the upside or towards the downside for inflation, so that has a tangible impact on that monthly metric, and therefore that feeds into the year-on-year figure. So some of these figures, some of these numbers for the likes of energy and food and things, those are the kind of things that are volatile, but also have a tangible impact on the annual CPI number that gets stripped out for core, because by and large, the likes of the Federal Reserve can't really impact energy prices all that much. So as we see here, the sort of drifting lower in terms of energy prices does portray a picture of the possibility of a, relatively weak month-on-month figure. Markets are expecting 0.3, but let's say it comes in at 0.2 again. It tells a story that we're sort of there or thereabouts when it comes to headline inflation. But there is a concern that we might see a resurgence in terms of inflation, and it comes from a number of different sources. First and foremost, it comes from the idea that we're seeing monetary policy moving into a position where it is becoming increasingly accommodative. It starts to stimulate the economy once again, and all of a sudden we see that disinflationary trend start to erode, and we start to see it reverse towards the upside. You can see here with the US M2 money supply change figure, you can see that if you sort of push it forward a year, we do have a tie-up between that and inflation, which would point towards a possibility of a resurgence in inflation as we see the money supply increasing once again. We haven't seen that bottom out and move towards the upside in a meaningful manner yet, but certainly there are some warning signs, and that is highlighted more within core than the headline, because like I said, headlines are the kind of thing that can be influenced by things like oil, energy prices. Core is going to be measuring things that really the Federal Reserve need to get a grip of. This is the breakdown for core inflation. Of course, we've got two main parts that we look at. That's core CPI, which we're going to be seeing on Wednesday, but also the core PC, which is the favored metric from the Federal Reserve. Well, this time around, we're looking at CPI. So 3.3 is the current metric. You can see, according to market expectations, they think that it's going to stay steady at 3.3. Of course, that's well over and above where we need to be, quite frankly. But nonetheless, we need to see the trajectory moving in the right direction. And the reason that, we're talking about, are we going to see a resurgence in terms of inflation pressures? Well, look at those monthly numbers. And in the same way, we can look at the sort of near-term trend and be able to gauge whether we're going to get back down to target soon enough for headline. We can see that things have gone in the wrong direction when it comes to those monthly inflation metrics for core CPI, core PCE. And that's because over the course of August, September, and October, for the CPI in particular, you're seeing 0.28, 0.31, 0.28. All three of them well over and above where we need to be, which is below 0.2 on the monthly metric. So that points towards a resurgence in inflation pressures, highlighted by the 3-month annualized figure we have at the bottom, which shows if you take the last 3 months of CPI and you project that out, what sort of pathway are we on? That would project a pathway towards 3.55. So that's higher than where we are at the moment. We're moving in the wrong direction. That points towards us potentially bottoming out. And it highlights why people are somewhat fearful and are pointing towards the Federal Reserve doing less than they had previously expected. In terms of the core PCE, bear in mind that is the favored core metric, and it's not necessarily as bad. You can see that August figure came in significantly below the CPI monthly August figure. Nonetheless, the last two figures have definitely been over and above where we need to be. So there is a question mark about the potential resurgence in inflation highlighted by core. And that's why if we're looking for this inflation report, core inflation is where it's at, right? That is going to be absolutely key. It strips out the things that the Federal Reserve can't impact, and it really highlights the things that they should be able to impact, domestic factors. Now, there's a number of different parts that go into these inflation metrics, and perhaps the biggest of that is shelter, right? And there are some concerns about the way that the shelter component is derived. And so people think it's very lagging. And you can see that here, right? That light blue line at the top sort of rolled over a lot later than all of these other metrics. And so it's a sort of slow to move metric. It's absolutely massive. And you can understand why, because ultimately when you spend money over the course of a month, generally your rent or your mortgage is the kind of thing that would be the mainstay of your outgoings. And so if we look at this, so what are the key parts that we're going to be looking out for? We need to see a continuation of that downtrend for shelter. And the fact that it's lagging should mean that we do see a nice long-standing decline. So, okay, the Federal Reserve might cut interest rates by a little bit, but that doesn't necessarily mean we're suddenly going to see a bottom for shelter. So that should help actually drive down inflation over time. But one of the concerns that we're going to have really is the likes of services. And you can see that with the services excluding shelter. So we're really trying to hone in on the services side of it and taking out that major shelter impact. You can see 4.5%. We've seen a resurgence over 2023. 2024, we see it rolling over, but we've seen it sort of ticking up a bit more recently. So we want to see that moving towards the downside once again for the services sector or for the services element. And you can see here for the breakdown between goods inflation and services inflation. Goods, whether you look at the CPI measure or whether you look at the PCE measure, both of them essentially at zero, right? So goods inflation is non-existent right now. And that really is highlighted by the fact that the Chinese inflation figures have just come out. The PPI number, okay, it moved higher, but it's been in negative territory for 2 years now. It's minus 2.5%, I believe it came in at. So essentially, China are exporting goods disinflation. And so we're seeing that here. Goods inflation, non-existent. Services inflation, that's where the problem is. It's over and above where we need to be. You can see currently services inflation, according to the CPI metric, at 3%. And so, you know, there's different ways of looking at this, different ways to skin a cat. But essentially, this really highlights why when you're looking at some of these different releases, you know, it's really all about services at the moment. So we're looking at, say, ISM manufacturing PMI, and certainly there's been some jitters over the months, over, you know, certainly the second half of this year when we see some weakness in that area. And I'm saying, you know, that doesn't make that much of a difference, quite frankly. You know, services is where it's at. And so if we see weakness in terms of the services inflation metric, then you'll be able to start to point towards the possibility of weakness for inflation as a whole. Now, I'm just bringing up on my own screen is the ISM services prices figure. So we're at 58.2 in terms of the latest ISM services prices element. So inflation within the services sector is a major problem at the moment, and therefore looking into that and seeing the direction of travel for services really gives us an idea of what those underlying price pressures are doing going forwards. This is a breakdown in terms of inflation expectations between the euro area and the US, and then looking at that differential, how that's changing, plotted against euro dollar. And this really highlights what some of the key drivers have been recently for euro dollar, yes, but also the dollar index, because the dollar index, if you look at the weightings, is heavily weighted towards euro dollar. So what can we see here? Well, we can see on the top end, if you chart the two-year swap from the euro area against the US two-year swap. So this essentially inflation expectations. We're looking further out for where we think or where markets think inflation will be. We can see this sort of rotation taking place where we saw a recent resurgence for the US two-year, and that didn't necessarily happen for the euro area. And so that differential is highlighted at the bottom with that sort of yellowy orangey line where we saw that decline also driving down euro dollar. So what have we seen recently? Well, crucially, we've actually started to see it rolling over in terms of the US two-year swap. And so that points towards a possibility that markets have now kind of got to the point where they're like, okay, you know, we sort of got very fearful about the idea that we're going to see a resurgence in inflation. Now we're calming down a little bit. And that will also have its sort of fingers in expectations around the Federal Reserve, right? So we saw this period of time where we just saw, you know, everyone thinking we're going to see a rate cut at every single meeting. And we thought we were going to see 50 basis points in November and 50 basis points in December, to suddenly, oh, we'll get 25 in November, and December we might not get anything, right? So we've seen a massive shift over a short period of time. It feels like that's come to an end. And part of that is highlighted by this chart here, but in actual fact things have shifted a little bit, because so over the course of a month, if you look back prior to Friday's jobs report, in actual fact over the course of the month we'd seen very little change in terms of expectations from the Federal Reserve. So we have had this period of sort of calm, and it feels like markets have sort of to some extent overshot and got really pessimistic about the Federal Reserve's ability to cut rates because Donald Trump came into power. Now we're starting to see it turn around a little bit more. Markets now feeling increasingly confident that we will see that rate cut in December, in part due to the fact that we saw an uptick in terms of unemployment rate in the US, and we saw, yes, we saw a stronger payrolls number, but the prior figure remained at 12K. So if you net out the two, ultimately you've got relatively low payrolls, job creation over the course of the 2 months. So essentially, what you're looking at here is a higher chance that we see a rate cut. And so that really points towards what we're seeing here, right? Where we're seeing that two-year rolling over. And so people, when you see inflation expectations ease, so we see higher expectations for rate cuts from the Federal Reserve. So that brings us back down to what's going to happen for this inflation report. Certainly, if we look at core inflation, which is where the sort of big issue is here, I think I've gone past it. Here we go. The last few months have been problematic. If we see another one of those, then it might start to undo some of the recent rolling over in terms of inflation expectations. And that could continue the trend of euro dollar weakness. Conversely, if we saw a weak report in terms of the inflation report and crucially that core metric, then you do have the possibility of this sort of rebound that we're seeing in terms of euro dollar continuing apace. Let's look at that right now. So this is euro dollar on a weekly time frame. Crucially, actually, if we look further out, this is the monthly time frame. So you have got a bearish trend taking hold over a long period of time, right? So the breakdown we're seeing at the moment does look like it's indicative of a potential top here as this market then breaks lower once again. But have we exited this range? Well, we've definitely taken out this area of support where we have these lows around just sort of 104.5s, 104.8, that kind of area, right? We've taken it out, but then we've rebounded a little bit. So we didn't necessarily sort of maintain price action below there. We didn't find it as newfound resistance. And as we've seen here, you can break below a low and then find that as the new support level. So is this going to be the bottom? Well, if we start to see weak inflation data out of the US, then potentially. But until that happens, there is still a risk that we do see a rebound for inflation. And so if we see strong inflation data coming out once again in terms of the core in particular, so there's a good chance that we start to see this rolling over. The key element here is that we are seeing this new creation of higher highs, higher lows. So a breakdown through this swing low that we have around about, let's just get rid of some of these lines now. So the likes of 104.6, if we break through that level, it looks like that bearish trend is back in play once again. But we're starting to see a little bit of bullish price action taking hold over the course of this month so far. Will that continue? Well, we really need to see some weak inflation data for that. I'm not sure that's necessarily going to happen, but certainly, where is it in comparison to market expectations? The markets have grown very accustomed to the idea that, they think Donald Trump is suddenly going to start to see inflation resurface. So as long as we don't see a surge in terms of inflation, that could still provide the basis for people to feel a little bit more calmer. We don't even need to necessarily hit 2%. We just need to be moving in the right direction and not necessarily seeing signs of a major bottom when it comes to US inflation. Now, another key area to be looking, of course, is US equities. I love trading equities, indices, because I like trends, and trends within US stock markets are very consistent over the years and over the current period. So this is the Dow Jones Industrial Average, one of the favorites for our client base. And you can see here that essentially we've rallied. We look like we've sort of reached this exhaustion phase, and we don't necessarily know whether we're going to top out and pull into a retracement or whether we're just going to flatline and then move higher once again. Part of that is going to come down to the near-term price action. Do we start breaking through your swing lows? Well, you can see this first swing low, which is 44568, appears to be providing new support at the moment. So, a break through that level on the 44420 starts pointing towards a retracement phase coming into play. But until that happens, we are finding support. There is a possibility that we could see the bulls start to come back into play once again. Ultimately, whether we do see a wider retracement or whether we see this short-term pullback finding support and we push higher once again, either way, I think that this trend is clearly defined. And until we see this 42846 mark taken out, then near-term pullback or deeper pullback, either way, I think they will ultimately resolve towards the upside for this market. But certainly for the near term, finding support on this key support level. Whether it's going to be a fleeting move or a long-lasting move remains to be seen. And certainly this US inflation report is going to be absolutely key, because if we do see a continued resurgence in terms of inflation pressures, it's really going to start to put pressure on the Federal Reserve once again and ease those expectations. At the same time that we're seeing weakness in terms of the Eurozone, we're seeing expectation for continued downside for rates. We've got the ECB coming up this week. So that euro-dollar pair is really going to be a key one to be watching out for over the course of the week. I hope this has been useful. And make sure to check out our channel, like and subscribe to it for any of the other content that we're going to be producing. Thanks a lot. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.